This is a quick update on the seller financing Dodd-Frank Truth in Lending Amendment 129C to the Chapter 2. Last year's SAFE Act passed, and this whole conversation is based upon that call Tuesday night that hopefully some of you were able to listen in on. This is my kind of download and summary of that. SAFE Act passed, as we know, and 3 weeks ago seller financing was exempted as long as it's not done in a business or commercial context, meaning you're not in the business of buying properties and do owner financing is like your entire business model. Most states allowing 3 per year without having to have any licensing requirements, but they still like you to comply with certain financing guidelines when selling to owner occupants. They like the loan to be fully amortizing, which means no balloon payments and implies no interest-only payments. They liked fixed interest rates and terms not greater than 30 years. The concern at this point is not the SAFE Act so much, but the Dodd-Frank Ability to Repay Amendment to the Truth in Lending Act, TILA, by adding 129C to Chapter 2. Many in the seller financing and private note world take this to mean that in order to offer owner financing to an owner occupant, you basically have to make sure they could qualify for traditional financing and document it exactly like a bank would. It sort of defeats the purpose. The beauty and value of owner financing is that underwriting is more flexible, thereby giving the possibility of home ownership to more people who would not otherwise qualify for traditional financing. This also places undue burden on ma-and-pa seller or a small-time investor who just, does a few properties a year, who will be overwhelmed and threatened by the regulatory implications. So that means less of it will happen and fewer buyers will be able to get owner terms, and thus the federal regulations will end up hurting the people they're trying to protect. Isn't that just kind of how it always goes? As I said earlier, sellers who offer terms are very motivated to make a deal that honors the buyer's/borrower's ability to pay because it's their money. They want their money. They want their retirement, their profit. They don't want a hassle. They just want the cash flow. It's the big companies, they're the ones put the loans together that don't make sense because they actually don't care. They make their money regardless of whether or not the loan performs. They just sell it off in the secondary market. So the Fed is still taking comments until July 22nd, 2011, when they will hand the torch off to the Consumer Financial Protection Bureau, who will oversee the Truth in Lending and SAFE Act, and they have until January 2013 to write their rules. So even regardless of what they end up deciding this year, probably won't go into effect for another year and a half or so. Most important comments, in my opinion, and in the consensus of the people on the call the other night, is let's ask to exempt seller financing from the ability to pay parameters required of professional lenders, that 129C. That seems very important. Allow at least, ask for owners who finance to be able to get at least a 5-year balloon on seller carryback terms, particularly older people who are in their 70s or 80s. They're not going to live long enough to collect on a 30-year loan. So a 5-year balloon is fair, and community banks are allowed to put in a 5-year balloon. Ask for seller financing to be exempt from all the regulatory shackles. That would be ideal. A seller should be able to do at least 5 to 10 per year, if not carte blanche, before having to get licensing and comply with the other regulations. For now, pay attention to the laws in your state and see how they are dealing with these issues. It looks as though each state's attorney general will greatly influence how these regulations are implemented and handled. One last item of interest. There was some discussion questioning whether or not the use of a licensed mortgage originator to process the paperwork in a seller finance transaction was an asset or a liability. And I had never considered that it was a liability, so it's something to think about. Okay, thanks a lot, and you have a great day. Bye-bye.